Hi, everyone, and welcome to the AI Interconnect, the podcast where we dive into how artificial intelligence is reshaping industries and powering innovation across the globe. I'm your host, Laurent, and today I'm thrilled to have with me Shawn Townsend, President and Chief Investment Officer at Ease Capital. And Ease Capital is a cutting edge tech-enabled commercial mortgage lender focused on multifamily and mixed-use real estate financing. Shawn, welcome to the show. Happy to have you.
Great, thank you. Happy to be here.
Wonderful. Okay, then that's going to be a nice conversation. Shawn, let's get started. Let's go back at the beginning. Can you
Mhm.
walk us through your early career? What role or experiences shape your views on financial and real estate?
Sure. I've got a long career, so lots of influences. But yeah, I'd say I took a probably a little different path. I didn't go, the typical American route, which is high school to university to, employment. I had other pursuits. I wanted to be a musician, so I took a few years off between high school and university.
Fantastic.
Don't regret it. Had a lot of fun, great experiences, and but it did put me behind the curve a little bit from a timeline perspective, but also gave me, I think, different views of what I wanted to do and when I chose to go into finance. Um, I made the early choice to go into, I call it fixed income versus equities, and by pure happenstance, at Lehman Brothers, in fact, ended up in real estate in the early days of CMBS and fell in love with the asset class and decided that was the path I was going to embark on. Very fortunate to have landed with Nomura Securities in the 90s. At the time, kind of one of the early pioneers of capital markets, the capital markets marriage with commercial real estate debt at the advent of the CMBS market. Fantastic group of people and leadership. Some infamous days back then. But what I learned there was, I would say, culture, accountability, and empowerment. I think, were some things I took away from the way that organization was set. Um, it did put me into a path that I wanted to learn every part of our ecosystem of the industry as opposed to just being focused on, say, credit or origination or securitization. So my career path and choices subsequent to leaving Nomura were based on me trying to find homes where I could hone and learn, again, each part of the real estate finance ecosystem, because I'm a firm believer that the more you understand how, say, a car is built and not just how the steering works or the brake works, you understand you can build a better, you can act and perform better in each role you choose. So I went and worked on the investment side as an equity investor for a short period, which was, gave me a different experience and perspective. Came back to credit, and my last foray was at JP Morgan before I went to the private side. After JP Morgan, I went helped launch kind of one of the first preeminent mortgage REITs here in the U.S. Company called Gramercy Capital. Uh, Fantastic group of people, great experiences, and taking something, building it from the ground up. Moved on from there to build a different platform based on private capital. Then was recruited to go build another credit platform from start at a private equity firm. So taking those different foundations and different types of capital and really garnering, I think, a lot of experiences on how to manage product against different capital sources, I think was super important. Um, but yeah, I mean, you fast forward now I'm here with these, and it is just the culmination and continuation of continuing to stay and evolve in the real estate credit space.
Wonderful. Beautiful. I mean, you took 2 years off, but you did a lot of things in between.
Yeah,
Uh,
yeah.
yeah, time fly, but yeah, you have a great experience in the credit market, and here we are. Let's um, let's talk about the origin of East Capital.
Mm-hmm.
Um, what specific market gap did you and your C-suites identify when 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 the company was launched in 2022, I think, and
Sure.
how has that vision evolved in the past few years? I don't know if you were from the origin, but you catch the idea.
Yeah. Yeah. So no, I wasn't one of the original founders. So a friend of mine from a past stopover, Gramercy Capital, he was one of the founders, and he had partnered up with a couple of great folks who their background really is in data and real estate data specifically, having built and founded some former firms focused on that, and setting the DNA of the infrastructure around taking that data, marrying it with these great advancements we have in technology to apply it to real estate credit. And real estate credit has been, I think, in the U.S. certainly a little bit slow adapter of technology and advancements. So the origin there was really going to be a little more focused in smaller balance, stabilized multifamily, where you could really aggressively apply some of the efficiencies of technology to sourcing, processing, managing that type of collateral. Um, when I came on, it was we were the mandate had widened, and it was really appealing to me because as we sit here today, post kind of the period of volatility and how it's changed the market segmentation of participants in the real estate credit space, we went from having a tremendous amount of growth, individual debt fund managers in real estate to uh, they're all either sidelined or impaired or slowed down from either a capital or execution perspective, which left an opening for how do you come in and fill this space. And by this space, I mean really this segment by and large really fills what we call the middle market space. And there's a great opportunity set between, I'd say, the very large, upstream large transactions and then the very small transactions. Um, and for me, what was very appealing was, as an investment manager in this space, it's about not only about how do you perform, how do you source, how do you deploy, how do you manage this risk more efficiently and effectively, but also how do you differentiate? Because we still have to go out and raise investment capital. We still have to prove our value to our client base and who we represent from a capital perspective. So, I've always tried to say, again, going back to learning how the entire engine works as opposed to just one part of it, I think has afforded us the ability to always kind of at least try and look a couple steps ahead and see where the market's going and where we can differentiate and provide, I think, enhanced or differentiated value. So for us, it was let's redefine what it means to be vertically integrated. In the past, it meant to be I have a credit business, I have an equity business, and the two kind of meet in the middle and makes us a better investor. That's true in a lot of cases. It's not true in many other cases. Where we thought and where we believe today is the vertical integration is bringing the technology and embracing these tremendous advancements that are happening at an increasing pace. And what is that called? Moore's law or terms. But AI in particular has caught up to a level that is shocking everybody. And I think we're all still adapting. But embracing that as an operator and having that as part of our DNA allows us to be vertically integrated there. And so the value proposition, what really appealed to us, and taking it from just a very single focused strategy to a broader mid-market lender and utilizing the technology and all that, we can get into what all that means. Super exciting and certainly differentiated. I think not to say that most of our peers or competitors or other participants in the space won't catch up, but I think starting from ground zero with that DNA gives us a head start because we can build the platform, bring our multi-cyclical real estate investment experience, and apply that day one with the technology. Easy to do that versus taking an embedded portfolio with embedded systems and then trying to kind of recalibrate and introduce new systems and this new technology. And do that real time on new deployment, new investment, and existing asset management, a much harder proposition. So that's our value prop. That's our thesis, and what we believe ease is, and what we're trying to kind of continually evolve that process.
Yeah, very interesting. I love it. And yeah, there's a lot of info. East Capital tagline is to make real estate ownership more accessible. Makes a lot of sense. How do you translate that mission into concrete day-to-day action on the platform?
Sure. I'd say, the one thing we can't fight human nature, right? And I think real estate, again, is a very fragmented industry. As much as it's commoditized and it's an institutional asset class, in the U.S. for both domestic and global investors, the day-to-day operator, be it if it's a 4-unit multifamily or it's an institutional REIT that owns a portfolio of 20,000 units, there is no continuity of standardization. One person operates a property, and then subsequently how they generate reporting, how they run property management, how they collect certain bits of data, how they process cash flows, et cetera. And trying to kind of force everybody into a certain standard template or format I think it's a fool's errand. So for us, I think, and again, the benefit of the technological advances with AI, and our team on the engineering side is really, we can't change human behavior. So let's take, everything from a mom and pop operator to an institutional operator, whatever format they give it to us in, a 1-page Excel to a fully blown audit report. We take it in and figure out how to process that and standardize it, take the data that's important to us, put it into our systems, into our underwriting infrastructure, standardized, and have that all automated, so we're not, putting human toil in there and human cost and time delays. That's the biggest improvement and the biggest challenge, but also the biggest opportunity, which we've been attacking. How that helps, more operators, make it easier for owners. Again, we're not trying to force owners, who are starting out as their first investment or their second investment to have to operate their business as investors or operators at an institutional level. Like, we're trying to make the access to debt capital easier, and we're trying to come to them versus them having to come to the market and, accelerate the I won't say sophistication, but the institutionalization of how they operate. Right, that takes time with any business. You start out, you grow, you get better, you get more efficient, you get more institutional. So that's probably the quickest or the easiest way we're trying to make that mission true.
Okay, yeah, love it, awesome. East Capital offer different products, 3 main products: bridge loan, fixed income, permanent, whatever it is. And how does AI and your digital platform enhance speed, transparency, and or risk management for that products?
Sure.
I guess it may be different for each of them, but in general.
Yeah, it is a little different for each of them, right? If we're doing a permanent or stabilized deal, there's less moving parts. There's less business plan execution versus a value add, where a property owner is either buying or refinancing a property that has a capital improvement plan to obviously improve the income profile. Put $20,000 into each unit to refresh, upgrade the appliances so they can drive rent growth from it, and bring it to more current standards. But I'd say the AI and the infrastructure and the design we put in place is really first and foremost around data. So I think we're very focused on data, not just what's readily available out there if you know how to go out and get it, but also buying data. There's robust, although fragmented, sources of real estate data here in the U.S. Most of them, rightfully so, are very protective of that data and want you to go through their UI to access it, which introduces a level of inefficiency that if you're looking at a deal, you've got to go log on to this site to pull up data sets, et cetera. So what we've done is really kind of take, and we continually improve and continually enhance our data set, is to collect that. we cleanse it. We use AI to help make sure we validate the data from all the different sources it's coming from, not just addresses, a lat longitude qualifier, but also, is it applicable? Is it a true comparable in terms of size, quality? It's obviously in our market. So we take that and then we do that with rental comps, sales comps, operating expense comparables. We also then allows us to take trend lines, et cetera. So are we seeing rents grow, decrease, stagnate, et cetera, within every comp within the 2-block, 4-block, 4-mile, 5-mile radius. So what that means for efficiency and transparency is that we get to develop our own view of risk and of the asset versus being a pure consumer of data that a client provides us that says, hey, this is my asset, these are my comps. Go out and find something to challenge that. So we have that all, and it's all automated for our team. So our credit professionals can come in when a loan is submitted. We have this very, I think, impressive automation between taking data that comes into us, the standardized submission information. We use the AI tools to read, pull out relevant information, populate our data, give our team a really clean view of what it is we're looking at, and differentiate what is it. Is it a fit for us? If it is a fit, where do we think what kind of bucket or silo are we going to put it into? And then we go into our own operating system, and again, they open up and all the comps are right there. Then they can go and manipulate the comps and find better ones. And then it automatically fills in to our underwriting tools. So we can develop a very, very quick, informed view of the asset and the risk return within 10 or 15 minutes, for somebody opening the deal for the first time, which is a great enhancement. I think, we've always had a challenge of how do we get quicker, faster, and more informed. And, in the past, we've used cheaper labor. We go offshore to have data entry and stuff, different compartmentalized parts of the process done offshore. I was never a fan of that. I think we're using technology in the sense that I think it's super important for our team that's working on the deals and that are making the initial assessment and judgments to have to synthesize that data, because it's important for them to have a full picture of what they're looking at as from a risk window. And if you're just taking somebody else's work product and summarize it, then you lose a little bit of that. But here, we've been very mindful to take the information that's coming in and synthesize it. We're just doing it really efficient. So we're taking data entry, and our CTO likes to call the human toil out of the equation without losing the perspective. So we have that. Again, it helps us, and again, our focus is a middle market. And the biggest impediment for capital to come into the middle market traditionally has been your average deal size is going to be 8 to 20 million thereabouts with a wider bandwidth, but your average, you have to settle into that. So if you're a much larger fund or a much larger investor and you're used to writing $100 million average investment sizes, you don't really get to shortcut the process, the diligence, the assessment. So for you to put the same 100 million, you have to do 5 to 6 mid-market deals for every one single 100 deal. The only way you make that up and maintain margin, be accretive, is to be more efficient. So, that's where our angle is going at. And you have to be responsive, obviously, to the property owner client side of the business. And the transparency comes into, we can much more quickly say, hey, listen, here are the comps we've pulled up on rental, on sales, to a lesser extent operating, and say, this is where we're pulling from. These are where we're seeing. Do you agree with them? Do they conflict with what you're seeing in the market? We can have an immediate discussion, as opposed to, hey, we're going to give you we like your deal. We're going to give you an indication of, here's what we'll lend to you at these general terms. But then the client is taking some level of risk that, hey, if I didn't go do, or if I'm not pulling all this data and getting comfortable with that view, the client and the lender are both taking, hey, well, if we're going to wait and see what the appraisal says, well, you're, 4, 6 weeks out. Appraisal can come back and say something different. We think it's better to be, even if it's not the right answer, if we're telling you we're only getting here, or if it's a flat out no, I'd rather give that to you immediately rather than everybody kind of take a long time to get there. So we're balancing that transparency and that certainty of execution and the processing through the technological implementation.
Yeah, I mean, yeah, understand. And yeah, makes sense. Then basically, you may have answered my question right now. I wanted to ask you what brings value into a specific deal. Your client today are uh, multifamily sponsors, developers,
Mm-hmm.
institution, obviously, um, maybe regional sponsors, and yeah, on a specific deal. Um, Anything else? Ease Capital brings value beside what you already
Yeah,
told me
I
about.
would say, yeah, it's a little bit of a loaded question. I would say uh, yeah, we try and bring value not only on the front end, right? Certainty of execution is certainly upfront for us. I think it's super important for not only our time, our resources, but also more importantly our relationships in the industry. And this is still very much a relationship business. Always has been, and that will not be replaced, in my opinion. So you develop long-term relationships with the intermediaries, the mortgage brokers, with the property owners, and everybody up and down the ecosystem. Um, it's in my opinion, it's always been easy. You always have to keep a sales hat on and say, this is how do you want to do business? How would you like to
Yeah,
conduct yourself? And again, the old adage, it's always easier to it's much easier to retain a client than lose one and have to attract a new one. Um, I butchered that term, by the way. The So we're very thoughtful on the front end. Again, trying to be very upfront, transparent. So hey, if we're not the right lender for you, we don't want to have you tied up waiting for us. You go find a better option. If we are the right option, we want to give you the certainty. And again, some of that's through the technology that I think is super important. That gives us, again, lets us develop our view of risk very quickly, as opposed to, hey, we're just taking your numbers and we'll figure it out later. That then leads to, hey, you told me you were going to lend me $20 million, but now we're committed and we're in, and now I'm signing due diligence. I might only get to 18. Right? That's not a good outcome. It's a reality, but it's not a good outcome. You try and address that up front. So there's a lot of money involved, a lot of planning. So for everybody, but more importantly, I'd say the additional value you asked about is post closing. I always tell our team, said this in firms, you know, when we're winning a deal, we're dating somebody, I'd say for 2 months, and we get to make a good impression. And when they sign a deal with us, great, everybody's happy. And I said, this isn't the time to celebrate. Like, yeah, you can have, you want to sign deals up, but now we have 3, 5, 10 years to really make a lasting impression and build a relationship with that property owner. And it is very easy to, um, it is much easier to ruin that relationship if you're not thoughtful about how you go about asset management. Much harder to be a thoughtful manager of that risk and develop that relationship. And we pride ourselves on doing the latter. The technology component, a lot of the tools we're building to make us efficient on the front end, as you can imagine, it's, sponsors bringing our property owners, submitting their rent roll and their financials to us one time during the closing process. When the loan is closed and we're managing that as part of our portfolio, they're submitting financials to us quarterly, annually. So we want to make that process as seamless as possible, so that they can focus on the real issues, which are, don't bother me with, oh, you need to change this, you need to change the format. None of that. It's about, let's focus on the real things that are impactful to the property. I had a water main break. We have to deal with insurance. That's a normal occurrence in multifamily. 3 new properties popped up that nobody knew was going to happen. It impacts supply and absorption. We're going to have a little bit of a dip, so we're going to have to work on covenants. Those are discussions. But the tooling we've done and enables our asset managers to not worry about the perfunctory part of asset management, so they can deal with the qualitative and the problem solving. And for us, that's real value add in managing our risk, but also more importantly, making repeat clients through that process. And we've done that, through several stops where, we differentiate ourselves in the asset management component that makes, even if we're more expensive cost of capital, the experience and the ease of use and the protective nature we have over their properties makes them want to be repeat clients. And that's the intent. So that's the other value we try and strive for.
Thank you. From your vantage point, what are the biggest trends currently shaping the multifamily financial landscape? And for instance, could it be the shift toward data-driven underwriting, or interest rate fluctuation, or sustainability requirement? What are the biggest trends? Shifts.
So I would say, probably in chronological order, probably I won't say trend, but what the entire market is still addressing is valuation resets. We went from, you have a multitude of assets that were bought or refinanced at zero rate environment that are now having to adapt and adjust to current rate, 4.5 plus or minus 4.5% treasury rate, which drives the valuations, and the SOFR numbers are less impactful. So there's a lot of reinventing the assets. So we see a lot of, rightfully so, people trying to then, maybe say, I'm operating at a good stable level, I'm getting good cash flows, I've got, decent debt on it, I'm going to let it be. Now I need to manufacture revenue because the interest rates have caused a cash flow coverage perspective, challenge, as well as a valuation challenge. So now I need to maybe put more money in earlier to help push rents up to get right size. And trying to marry that up against a more conservative lending environment across the board. Although that's starting to loosen a little bit. So I think that's the first thing everybody's addressing. And that's going to be here for a while. I think it's going to take a few years for that kind of adjustment in interest rates. I don't think we can, cross our fingers and hope that rates are going to drop back down, certainly in the state of the environment we're in. So I think there's an acceptance and acknowledgement of that. I do think efficiency, not only at the multifamily, at the property level, but also at the capital, at the lender, at the investor capital perspective. This is a trend. It's not a trend, but it's a reality for every investment and everybody in an ecosystem. Is you're trying to protect margins against a compressing yield profile and a rising cost profile. So at the asset level, rents are fairly, the general rule of thumb is rents are fairly stagnant. We've had tremendous amount of rent growth, so we're going to hold tight and let the economy catch up. But operating expenses are rising at a disproportionate pace in taxes, insurance, labor, etc. So margin compression at the lender perspective for us, our revenue streams off of management fees, etc., are compressing, but our cost of labor continuing to go up. So compressed margins. The institutional capital that we manage, it's the same exact thing, right? They're raising more money, putting it out, compressing management fees, but costs continue to go up. So that trend, I think, is having a more meaningful impact on, to your second, one of your points you made is, how is, are we getting more into a technology-driven, AI-driven underwriting or what have you? I would say globally or directionally, yes. I wouldn't say everybody's attacking it the same way. I think everybody's looking at how to generate more efficiency to protect margin. And, again, we're looking at it from a pure technology perspective because there's real, immediately realizable efficiencies and benefits to mitigate that concern. Everybody's doing a little differently in terms of how they manage cost or operating efficiency to protect margin. So I don't know if that answers your question, but that's kind of those are the trends I see.
Yeah.
Anyways.
Fair enough. Yeah, it is. Let's move on to challenges. And no fast-growing fintech is without its challenges. And
Yeah.
what have been the toughest pain points at East Capital, both could it be technological or operationally?
Sure.
where do you see your major challenges or pain point at that point?
Yeah, I think without giving too much, I would say no, I would say
No, don't talk.
thematically, listen, I think there's a healthy amount of skepticism about what the technology can do from outsiders. So, for instance, if we are, as we are pitching more mandates to manage money, um, there's a healthy skepticism of, is the technology just the shiny new toy, or is it actually generating benefit? And that's incumbent upon us to go through and work overtime to show those benefits and show the applicability of those benefits. And it is more directly recognized by us as an operator, as a lender, maybe a little less so to an investor that we're trying to onboard as a client. So we have to show them that again, we can be more efficient at sourcing appropriate risk credit for you, and this is the risk return profile of this type of capital. We need to show that, hey, this is how how our application or utilization of technology allows us to source and manage and be efficient with bringing that risk profile in, but also being very efficient about moving those assets through the top of the funnel down to where it's actionable, deployable investments. Because deployment's a big challenge. There's a lot of capital being raised, albeit in a smaller subset of managers. That's a bottleneck, right? So deployment is a big concern. And then showing how the technology and the infrastructure we've built will then provide greater transparency, greater ease and efficiency of reporting, greater connectivity to their own internal systems to take, again, some of the human interaction out of the same data having to move from point A to point B to point C. So those are challenges, because I think there's it's human nature. There's just skepticism if you're not actively involved in this day to day. At the same time, right? We've drinking on Kool-Aid because we're living it day to day. So it's a balancing act of the enthusiastic pitch versus balancing the reality check of how an outsider views it. I'd say that's been the biggest challenge. I think we're fortunate that we have a great team of engineers, and our real estate team is by design bought in. And there's a great, I think it's super important. There's a great 360-degree feedback loop that, engineers don't talk real estate doesn't talk engineering. So you have to have a very healthy feedback loop, and you can iterate and, make the development and the evolution of our product more efficient.
Yeah, that was exactly my last point. Recruiting talent is not part of your challenges, or it is.
Yes and no. I'd say recruiting right now is tough for everybody in real estate. I think there's and I don't think it's a challenge for any one particular firm or segment. I just think we're just in that part of the cycle where recruiting's a little harder than normal. I think and to be, I think, a little crass, I just think we're still in a little bit of a down cycle. I think there's always the delta of where cost of talent versus where the reality, where the market is. There's a delta there. So I think that's a challenge everybody has, and I think for us, we're not unique to us, but unique to more of a startup or an early stage company. Is you still have to attract and recruit talent that buys into the strategy and is willing to take a little bit of risk themselves into a newer entrepreneurial venture versus going to a very stable, sizable institution. But again, that's a normal risk. Yeah.
Yeah. No. Of course. Looking ahead, what's next for East Capital over the next 12 to 18 months? Expansion?
I'm sorry, was it construction? Is that what you said?
No. Expansion. Expanding into new product line, for example.
Yeah. No, that's absolutely the goal. I think where we are today is I think the opportunity set is very clear. Mid market is where I think the biggest opportunity to fill, not a void, but I don't think it's as competitive as it has been in the past. So establishing our brand in that segment is super important, and so we're staying very focused on that, particularly in the bridge space. The fixed rate bucket is something that we add on. That's nice as a product offering. It's also nice from a platform management perspective. Um, as a multifamily specialist, it would stand to reason that we would want to figure out how to get into a little bit closer to agency product, to expand the offerings there, and we're looking into some options there. Um, yeah, I think the biggest thing for us is we've got I think a laundry list of ideas we think make sense, but we also I think being disciplined and being somewhat reactive to how the market's moving. We're still not in a normal market. We have this number's probably a little dated. We run as a market, we're about a $6 trillion market for commercial real estate. Roughly half of that's multifamily. Um, Across all segments, we typically run ballparkish about a $500 billion maturities per year. Um, that's been backlogged through a lot of stress, and lenders, extending loans because of the balance, because of the valuation impact. I think the last estimation was we have 3 years worth of maturities backed up on lender balance sheets. That's not sustainable, and that's going to create a different type of distortion in the forward 12, 24 months. So we're trying to be thoughtful about as much as we think we want to do X, Y, and Z, we have to be cognizant of the fact that that's going to create a different trajectory that we're going to have to be reactive to. So, and we view it as opportunity, not as a negative. We want to be prepared and positioned to take advantage of that. So,
Okay.
not kind of an
Any?
answer.
No, no, no. No. It's perfect. I love it. Every answers are good, and that's why I'm asking 2 or 3 times the same questions.
Sure.
What about a strategic partnership with PropTech platforms, or to
Mhm.
integrate into your risk dashboard, maybe, or something like this? Is it part
Yeah,
of your?
I think we know some of the players out there, and I think we've had some more discussions around what are each of us doing, and more of a um, understand what everybody is focused on as opposed to what are the strategic opportunities. I think uh, there will be strategic. The goal is to have some strategic alignment. Uh, First and foremost, more likely with capital, and to kind of advance our distribution capabilities, and that allows us then to be more, I'd say, opportunistic and go on the offense to find more strategic ventures on the operating side, as you suggest, with some of the prop tech operators, et cetera. Um, I think we're probably a little too early stage to be focused on that. To be fair, but I do think there's definite
Okay.
advantages as we scale up to a point that makes sense. But we're not there
Yeah.
yet.
And okay. Any um, any idea of evolving into a broader platform like CRE, a commercial real estate finance, or something like this?
Yes, it's something we've discussed. I think there's two reasons we focused on multifamily. I think first, from a technology angle, right, as we are very focused on the data and teaching, bringing the AI component to our infrastructure and teaching it. I think from a time to market perspective, it's much more reasonable and real to focus on a single asset class versus trying to teach it and bring all the different iterations and variables from multifamily to retail to hospitality to office to the different asset classes. So from a technology implementation and speed to market, you know, makes a lot more sense to focus on multifamily. From a real estate and from a credit perspective, multifamily is, it's just really that's the risk on asset type. And in the U.S. in particular, despite, forgetting when you get surgical into different markets, but, from a macro top down perspective, we are still systemically undersupplied on housing across the board, from ownership to rental. So that supply demand fundamental is very attractive, and it lends itself to obviously a broader berth of opportunities. Quite the opposite is office. Office, we are overbuilt to supply because we've gone through post-COVID fundamental shifts. But I don't think it's not as severe in Europe, but it's still very severe here in every major market in the U.S. that the utilization of office space is going to have to be reimagined. And I think we're still trying to figure that out as an industry. And so from a lender perspective, very hard to look at an office investment and lend on an office property, save for a few specific markets that, don't provide, the requisite return to take on that risk. And valuations are still, a little bit unknown. But as we expand into other asset classes, I think we've talked about expanding into things that are more highly correlated to multifamily, like self-storage. Love that asset class. It's gone through its peaks and valleys, but still fundamentals are strong. Mixed use, bringing retail back into the fold a little bit more slowly is attractive, because there's always going to be demand for that. It's just a matter of gauging the right level. But in the foreseeable future, I don't see us going into office or hospitality. Industrial is an entirely different value proposition. But as part of our mandate, we manage debt portfolios that include office, retail, et cetera, for institutional owners. So we're already involved. Our history, we've involved in all CRE. It's just eases multifamily focus, but we are still actively managing portfolios of full CRE. So it's not in any case, when we go to do it, it's not, we're jumping from zero to, from nothing. So it's just a choice to stay focused on multifamily for a while.
That makes sense. Okay, let's do a short rapid fire round and just answer very quickly. One thing,
sure.
Every fintech founder or executive in real estate should start doing today.
Wow. Not sure I know the answer to that. Maybe my opinion is probably, have a little bit more perspective on the applicability of the product to a uninitiated audience. So if you're selling this product to an investor or an end user, probably have to translate it back down to what they're looking for versus selling the product, very tech forward, if I will. If that makes sense.
Yeah, great answer. One common mistake real estate sponsor make when raising capital?
Syndicating. I'd say in this environment, if you are still trying to syndicate equity, I think you're putting yourself in a higher position of scrutiny with lenders. We've just had enough of a track record through, we've had some bad cases of bad syndicated equity as opposed to more traditional, LP routes.
Okay. And this one is technology in PropTech or Fintech. You think is overrated right now?
Oh, gosh, I don't think I have an answer.
AI couldn't be anyway. It's
yeah.
No, me either.
I would say, yeah. I mean, and the pace at which, yeah. And listen, I think that the pace at which AI is progressing and evolving, I think it's going to. I'm super curious because I think it's going to negate some infrastructure. It's going to start doing things that we and others are building right now because it'll automatically be able to do it. So scary proposition, but also exciting. So.
Yeah, no, exactly. I mean, you're very curious. I am very curious. It's exciting to know it could be scary, but then again, everything is scary.
Yeah.
Anyway, uh, Thun, Shawn, this is great. This has been an incredible conversation, a rich conversation, and I thank you very much for your time. It was very clear, and I'm very happy to have this conversation because you're one of the few fintech we start talking to. But as you are building into fintech and PropTech at the same time, it was interesting for me to have you on the show. And to wrap up, could you share one or two key insight or pieces of advice you would give to our listener or who are builders and investor or entrepreneur at the intersection of AI and real estate? Any piece of advice?
Sure. Well, first, yeah, thank you for having me. It's been a pleasure. I thoroughly enjoyed the
Yeah,
conversation. Uh, as to a
very
piece of
cool.
advice, I would say, uh, nothing goes to plan. So, have plan A, plan B, plan C, plan D, and figure that, you're going to have to deviate. I'd also say, very much like what we just said, AI is evolving at such a rapid pace. I think that overlay with a very volatile real estate investment market. By volatile, I mean, again, we're not in a normal market and there's still a lot that has to happen. So things are not predictable as normal in the real estate investment space. So if you marry up the fast evolution of AI into a still volatile investment market, you're going to have to expect that things are going to go awry and off plan. So I think, um, it's a necessity to have to maintain flexibility and uh, not be so rigid in your plans, and you have to be able to. That would be like my single piece of advice.
Fair enough. Perfect. If anybody wants to get in touch with you or learn more about the company, where can they reach you?
Sure. Our website is easecapital.com, and my email directly, I'm happy to give it out, is just Shawn, SHAWN, at easecapital.com. And always happy to talk to potential borrowers or people who are interested in just hearing what we're up to.
That's fantastic. Thank you, Khan. I appreciate your time and transparency, and I know our audience will take away some actionable ideas. Thank you very much.
Well, thank you. Enjoyed it.
Thank you, Sean. And that's it for today's episode of the AI Interconnect podcast. And if you enjoyed it, share it with someone who's building the future, or better yet, someone who should be. And until next time, stay hungry, stay foolish, and keep building. Thank you, Sean. Bye bye.
Thank you.